We are very excited for our climate investing panel. My name is Megan Morris. I'm the Associate Director of the Sustainable and Impact Finance Initiative here at Haas, and we got to organize several sessions on climate investing in some way, shape, or form or another at this conference. So I would like to hand it over to our moderator, Sabin.
Thanks, Megan. You guys all here? Oh, there we go. Nice to meet you all. My name is Sabin. I am an investor at Ecosystem Integrity Fund and a proud Haas MBA grad. Ecosystem Integrity Fund is a sustainability-focused venture capital fund. We invest in a variety of different types of companies: energy, transportation, agriculture, things that we really believe are creating systems change within those sectors. And we've been investing since 2010, now out of our fifth fund. So I'm going to be moderating today's panel. If you have questions, put them in the WOVA app. I will look at them. If I'm looking at my phone, you know that I'm looking at that. And excited to introduce the rest of our panelists today. Mira, do you want to start?
Sure. My name is Mira Inbar. I'm a partner with ArcTern Ventures. I'm also a Haas alum, so it's nice to be back here. ArcTern is an early stage climate venture capital fund. We focus on what we call Series A and B, so early stage and climate. And we're a generalist, so we invest across all the categories of climate, including resiliency and adaptation. Maybe just a little bit on my background, because it's non-traditional to venture, which could be interesting for some of you. I spent my whole career working on climate, and I worked in really hard to decarbonize sectors prior to coming into venture. So I worked with the mining industry in Africa. I worked with the chemical industry. I worked in utilities and oil and gas, and always on clean energy. And then I came to venture with that background. So that's me.
Hey everyone, I'm Marisa Sweeney. I'm a principal at S2G Investments, and I work on our special opportunities team, which, despite the somewhat mysterious name, is actually a debt and structured equity investment team. And we tend to focus on more asset and infrastructure related investments. Prior to my experience at S2G, I worked at Generate Capital, where I was there for about 7 years. And our strategy on the special ops team is quite similar to Generate Capital's mandate, which is just this idea that for climate specifically, where we need the capital to flow is into capital expenditures and very CapEx heavy destinations, and building that bridge to allow bankability to be more available to different companies and solutions is absolutely critical to the work. So I really think about that as where my career is focused and where I plan to spend the next 30 years of what I do. Prior to Generate Capital, though, I worked on the renewable energy development side. I worked for a Blackstone-backed company, primarily acquiring C&I solar assets, which is really where I cut my teeth in the climate space. And ahead of that, I worked in credit risk, which, if you're at all familiar with infrastructure investing or debt investing, kind of credit is really at the heart of the investment analysis. And I would just say I don't have an MBA, so I always feel a little sheepish at these gatherings, but I've just been kind of in the workforce since I graduated.
Thank you. Hello, everyone. My name is Mandira Reddy. I'm a director at Capricorn Investment Group, where I lead our climate and impact initiatives. I work closely with a number of our portfolio companies and fund managers, and I'm also responsible for leading our thought leadership work on behalf of the firm, which includes things like writing research, white papers, and such, and also helping our fund managers improve their operations. What is Capricorn Investment Group? We are a $12 billion asset management firm. In industry jargon, we would be called an outsourced CIO or OCIO, which means that we manage endowments on behalf of family offices and foundations. We also have a separate fund that we run, which is called the Sustainable Investors Fund, which provides growth capital to other impact-focused asset management firms. Very happy to be here. I was just joking that I feel 20 years younger being back in school, so thank you for allowing us to be here, and thank you, Megan, for making this happen.
Wonderful. Well, let's start off talking about the market. So macroeconomics, macro headwinds do affect climate investment. How are you all seeing the climate market today? How has it changed over the last few years?
So I would say the macro tailwinds remain very strong for climate. And so, for example, even if you took away the solar ITC, solar energy would still be cheaper than any other form of energy. And so the economics behind renewables is very strong. And that is showing up in increased investment from players like both on the venture stage as well as the growth stage. The federal landscape is very bleak. So, whereas the Biden administration was the most transformative administration with the IRA for climate, the Trump administration is the polar opposite. And the cuts in NOAA, the cuts in the DOE, the cuts in the EPA is making it very difficult at a federal level and from a data perspective for climate. So I think that that's sort of this disconnect, the rhetoric that we hear and what's happening at the federal level versus the economics and the way the markets are progressing is a bit of a disconnect because the markets are strong. So we invest in companies that don't require federal grants or loans, and that's a big part of our thesis. And so most of our companies are not affected by what's going on at the federal level. But, it's a strange time for climate because the rhetoric is very anti-climate at that level. That said, I think you will see things at the state level, and I think you will still see things at the corporate level where economics make sense. So I like to give an example of a company of ours that's in the solar industry whose biggest partner is actually Hobby Lobby, who never had an ESG program, who's publicly said that climate change is a hoax, but solar just makes so much sense from an economic standpoint, and they're going gangbusters with it. So that's where we will continue to see, and we just need strong business models that leverage strong economics and companies that are good businesses. They make money, they have good margins, and that is very true in this sector.
To add on to that a little bit, I think when you're thinking about building out infrastructure that's meant to last 20 or 30 years, in general, infrastructure-oriented investors are sensitive about taking binary policy risk overall. And I think what's challenging about the current environment is that we're seeing things at the federal level that are kind of shaking the foundation of certain types of subsidies, for example, the ITC, or for example, the renewable fuel standard, et cetera, where folks are just not quite sure where things will shake out. And I think that type of rattling, especially in the first 100 days of this administration, is very bad for the market, which I think being MBAs, you would understand that volatility is not conducive to making 30-year investment decisions. But I think that being said, if you really dig into who are the interest groups that benefit from many of these programs, there's quite a lot of purple and there's quite a lot of red. And I think I remain at least optimistic that although it's quite bleak at the moment, there will be pockets of things that definitely continue to be able to make it through because A, they make good economic sense, and B, they benefit constituents in areas of the country that are important for many, many people. And I think the second thing I would just also say is what you'll also see is states like California that are historically leaders on the policies that contribute to climate businesses being able to scale and function well are going to lean in even harder to their goals in response to this. So while it might look grim on one level, there's kind of always threads that are pushing and pulling for that interest. And I think the third piece that I will end on is just that this kind of conflicts at an unfortunate time relative to capital raising for a lot of climate companies. You came off a 2021 market, which was absolutely hot. And I think what we've seen is, A, unfortunately, a lot of companies go out of business, and B, a lot of companies kind of cobbling rounds together through insiders, bridge rounds, and down rounds to try to make it through the next milestone. And unfortunately, this wave at the federal level is not necessarily going to be great for a lot of those businesses, and will kind of put a lot of pressure on what does runway look like, what does success look like. So I think that's one area that we're very, very keyed into is understanding, well, one, are there opportunities there from an investment side? But two, how does this inform our ability to think as investors going forward, kind of like when you're in a similar market cycle?
Yeah, very similar sentiment from me. Just to frame it all, I think there's three key determinants of the pace of capital invested in this sector. One, of course, especially in current times, is policy. Then there's market factors. Number two, both supply and demand and technology advances. I think on the policy side, we've obviously seen a lot of push and pull. The IRA provided a huge boost to this sector a couple of years ago. With the current administration, there have been more skeptics around the IRA or many parts of the IRA. However, we cannot ignore what's going on in the other parts of the world. China has been investing heavily into the sector. Europe has been continuing to push on. So I think this goes beyond the climate narrative. It's really about staying competitive as an economy. Even among the red states, if you look at the amount of solar or renewables deployed recently over the last 5-10 years, just behind California are states like Florida and Texas. And they're doing it just because it makes sense economically. Even globally, 85% of all energy deployed last year was renewable energy, and of course that would not have happened if this wasn't an economically sound model. On the market side, there is expected to be a huge surge in energy demand. I was reading a stat somewhere in the amount of energy that's expected or capacity that's expected to be added in the next 20 years is something like 6 or 7 times higher than the amount of energy that was added over the last few years. And solar and wind are, again, they are the quickest way to deploy this energy and do it in the most efficient manner, especially now with batteries becoming much cheaper. Costs have fallen many fold in the last 10 years. So battery capacity is expected to increase. On the innovation side, we have some venture investors over here. There's been a lot of momentum both scientifically and in terms of investments, things like fusion energy, geothermal, long-term battery storage. There's good momentum there. I think that would be hard to slow down. So overall, yeah, there is obviously a bump in the road currently. People are in a bit of a wait and watch mode, but I think the underlying fundamentals remain strong. As investors, of course, it is our responsibility to look at the details of each investment. I think if we were to just invest in a macro trend of climate, we'd come out disappointed. So we'll have to make sure that every model that we invest in is financially sound. And this type of volatile environment also provides some great investment opportunities. Equity dries up, debt dries up. So for specialist investors who understand these assets well, you get to go in at very good valuations, and these valuations will eventually go back as the situation normalizes. So overall, yeah, we continue to be bullish in the long term and be ready for some bumps here in the short term.
Thank you all. We're quite lucky to be on a panel with very different types of financial allocators here. And so I want to take a moment so you all can really understand the type of work that each person here is doing. Mandira, could we start with you? Would love to hear, as an asset allocator, how do you think of capital investments into different stages, different types of financial vehicles?
Yeah, so as I said earlier, we are an outsourced chief investment officer, which means we get a whole balance sheet, and then we're responsible for investing that balance sheet. When we start making these decisions on behalf of any investor, it really starts with the financial goals. What type of liquidity does this investor need? What type of growth is needed for the portfolio? It might be, for example, a foundation endowment, and their plan could be to use about 6% of this endowment to provide grants every year. So which means that we need to produce 6% in liquidity every year. On top of that, they might wish to continue this endowment in perpetuity, which means that they never want to spend it down. Which means that if they're spending 6% every year, we've got to at least earn 6% every year. And on top of that, there is some inflation adjustment. So let's say 8 or 9% growth annually, which seems like an easy number to achieve, but it is not an easy number, especially when you take into account risk and return volatility constraints and such. So once we have an understanding of those requirements, the next step would be to decide on an asset allocation model. What percentage of the investment should be in venture versus private equity versus infrastructure versus credit? Each of these asset classes are unique in their risk-return profile, and also the type of access to capital they can provide to capital solutions. we arrive at that model. It could be like venture, for example, is low in liquidity, so we cannot count on that asset class to produce cash flows. Once you put in an investment in a venture fund, it's locked away for 10, 15 years, sometimes longer. So definitely cannot count on it for near-term cash flows. But it provides a huge opportunity for outsized returns, and also provides an opportunity to align capital with truly transformative solutions. Now you balance out that illiquidity with like a private credit or infrastructure fund where we know how the yields are coming in. There are these solid power purchase agreements on the other side. There is cash flow that comes in fairly consistently, which the foundation can use towards its spending needs, whereas the venture portfolio is used for its growth needs. And within each of these asset classes, we then build pipelines of investments to fill out the portfolio. And at the end, the idea would be to blend individual assets in a way that we can both align the values of this portfolio with the values of the organization. So if they're a climate-aligned investor, how do we maximize alignment of the portfolio to climate? It could be an investor that's promoting financial inclusion. So how do we bring in more financial inclusion assets into the portfolio? So respect that objective and also make sure that we are meeting both the short-term and long-term needs financially for any investor.
Thanks, Mandira. Marisa, going over to you, you work at the Special Opportunities Fund at S2G. I know S2G has a few other different types of vehicles that they use. Could you help us understand the difference between what you do and what some other parts of the S2G team are working on?
Absolutely. So for any of you that are familiar with S2G, you may know us as kind of historically an investor in early stage food and ag businesses. And that's where we got our start about 10 years ago. We launched a venture strategy and did two vintages in that strategy. And kind of about 4 years ago, we added additional thematic areas of clean energy and oceans, which kind of gets at marine decarbonization, aquaculture, and recycling. And I always like kind of throw that in there because people are kind of like, what does oceans mean? And oceans really just means kind of anything that covers our oceans and making our planetary health at that level better. What the S2G senior team realized is that if you really want to have scale and impact, being able to bring more capital to the market and bridge this missing middle gap was absolutely critical. So in about like the past year or so, we've transitioned from being more of a venture stage investor to more of a growth-oriented investor. And our team now works across those three categories, primarily making equity investments in the later stage venture kind of field and even kind of private equity middle market buyout type area. So pretty different shift in strategy, but all with the goal of mobilizing more capital and more impact into our three thematic sectoral areas. With all of that being said, I work on the Special Opportunities team, which, as I mentioned a little bit in my intro, we're a $300 million fund that focuses on making investments that are oriented around assets, contracts, cash flows, and just at a very high level, predictability. Our cost of capital is around the mid-teens and call it like a 1.7 MOIC, which would translate to predictability at some level, but also like a level of spiciness that's a bit more exciting than like a senior secured BB bond, which I often think if in venture you're kind of shooting for the moon and trying to get that 110x. I think in our line of work, you're often looking at all of these ways to invest in capital intensive things and ensure that you're not accidentally inadvertently taking a kind of 30% plus IRR type risk with your 15% money. So we're in the business of thinking through the risk, the opportunity for upside, and how to like get as much downside protection as possible. And we do that by boxing in a couple areas. We typically are not trying to take technology risk because, again, that's too equity-like and spicy. It's not where we want to be. We want something that's proven and scalable for our dollars. And we're typically not trying to take risk on the revenue side. And ideally, we're able to get a PPA or a contract. But even when we can't, we'll spend a lot of time trying to understand the predictability of cash flow for a given investment. And I think the third piece, and this is less about the underwriting criteria and more about the scalability of the fund, we're really focused on working with companies to stretch and figure out, okay, how can we allow you to scale your business using these tools and using this risk framework to do something that's maybe a bit unconventional, but can also offer an alternative to just simply raising more equity. So I'll give an example for a transaction I'm working on right now. I'm working with a robotics company that's in the kind of industrial efficiency space. And they have a proven technology. They sell to customers under an as-a-service agreement. These assets are pretty sticky. Once customers have them, they tend to like and keep them. And they're able to get really cheap financing if they can get a 5-year contract. But many customers are like small mom and pop companies that have not actually had a robot before, and they're not so sure about a 5-year contract. And what they really need is a facility that allows them to do 1-year contracts. So we've kind of gone to great lengths trying to diligence and structure how we might be able to provide a non-dilutive asset facility that finances these robots, and admittedly is taking more risk than their other flow providers, but we're able to structure through a mix of warrants and bankruptcy protection to get comfortable with that investment and ultimately allow this kind of venture-backed company to scale their business pretty materially, like to the tune of maybe like 4 to 5 times the number of installments they have today. So,
love the examples. So this is a question that I get a lot, is how is climate venture capital different from typical Silicon Valley investing? Mira, do you want to take that one?
Well, there's so many ways, but there's also so many ways it's not. But so most Silicon Valley investors are generalists. They invest across lots of different categories. Climate fund is obviously just climate, but within climate, there is so much that touches climate. So in some ways that's different, but in some ways that's very similar because we're also a generalist and we touch every single sector of society because climate touches every single sector of society. We have the same financial expectations that any other VC would have. We're looking for massively scalable businesses, huge returns in a very short amount of time. And that is the same. So sort of a lot of our metrics are the same. What is different is that we take our first screen on carbon impact. So the first thing we look at is what is the carbon TAM, total addressable market. So how much can this company reduce if they were to capture the whole market over 5 years? And we have a certain threshold. Ours is 200 million metric tons. And if it hits that, great. And if it doesn't, we kind of really need to understand what's the environmental impact, and we debate that. So that doesn't mean that we only do mitigation. We also invest in a lot of companies that help sort of, we help with adaptation or resiliency, are sort of enabling technologies. But it's a debate and it's a conversation that we have as a fund because that keeps us really true to the climate thesis. And it can get very broad and loose if we don't kind of have that as a guiding light. Once we pass that, we're just a greedy VC like any other greedy VC.
Could I put
please.
Mira in the spotlight, just ask her
Yeah.
one question there? So we've seen in our portfolio that there are companies, especially the ones that require more capital. They do great in the venture stage because there's so much excitement and there's opportunity to create so much value. Once they get into the phase where they require real capital investment, they've moved on from their R&D phase and they require capital, the value of debt as they call it. It's been a bit of a struggle to attract that type of capital because the expectations for the existing venture investors don't match the expectations for any new coming investor. Have you seen any of that for a portfolio, and how do you think of that risk for the portfolio?
Yeah, so I would say this is where we are different, I think, than some climate VCs, where some climate VCs will be very technology-centric. And they tend to be funds, and every single climate VC is very different. So if you're interested in this space, it's really worth understanding all the nuances and where would you best fit. But some climate VCs are very technology-centric, and they have a lot of PhDs on staff, and they make a bet based on the technology. And they say that the market will come because that's the best tech, and the team, I can get in there and fix the team. But we're a team of 12 people. So for us, revenue is sort of the indication that the technology works. And by the way, revenue is also an indication that there's going to be climate impact. Because if you're not selling, you're not making a climate impact. So we have a very strong focus on team. We have a very strong focus on revenue velocity. So we do have some companies that are pre-revenue. And I would say it is hard to raise money when you don't make money. And now with a lot of the things Marisa was talking about, later stage investors becoming more risk averse, we are not in a hype cycle anymore. We are in a more risk averse financing environment. It is hard to raise capital, and especially for capital intensive things. And so we have that in our portfolio. So I think it's really, that also kind of comes back to the team, and we always have this discussion of what are the later stage investors looking for? And do we think this company can hit those milestones by the time they go? And is this the right team to raise money? If we don't feel that the team is strong enough to raise money in a very tough environment, it's probably a pass for us.
Thanks, Mira. Mira, do you want to talk a little bit about any climate investments in your portfolio that you think are going to be really beneficial in their sector? Maybe just give people a sense of one or two portfolio companies you're really excited about.
Yeah, I really like the diamonds in the rough, the companies that are so boring you would never hear about them. So I have, they're my best performing companies. So I have one company called King Energy, and they're in the strip mall category. So you've probably flown and seen all these strip malls with all these huge roofs and wondered, why aren't people putting solar on these roofs? There's a couple of reasons. The main reason is that you have a split incentive problem, where you have one owner that owns the roof, that's the landlord, and then you have all these different tenants. And in C&I, commercial and industrial market, those loads are very different. You have a nail salon next to a bowling alley, next to a liquor store, and it is hard to bill all of those tenants. So they're the combination of a fintech and a solar provider. So they have a billing solution that bills every single tenant and can predict their load and basically saves them a percentage off of what they would have paid on their electricity bill. So that's the fintech part. And then they rent the rooftops from the landlord, and they're financing. And so this is a big untapped market, and they're now in 7 states. And they're a company that kind of beats their forecast, so that's always nice. Because once you're in venture, you understand that most companies never hit their budgets. So you have one that exceeds it. It's exciting.
That is exciting. Marisa, any particular ones that you want to talk about?
Yeah. So I'm happy to talk about a company that we have called Nova Clean Energy. They're honestly a really talented and top-notch developer in the conventional renewable space. And I think it's interesting because we were able to structure a development facility for them that gave them a credit around their development pipeline and basically has a borrowing-based structure that sizes based upon the maturity of the assets. And this is a type of financing that we in Special Ops are very interested in giving, especially to developers that are credible and have a proven track record. And in this way, like, development businesses are not typically like VC financeable businesses, but the assessment that you do when trying to like choose a good developer is actually extremely team focused and very much like a venture style management team assessment, because at the end of the day, you're trying to choose an entrepreneur who's really trying to make something out of nothing, and their track record and ability to do that, whether in the immediate space they're working in or adjacent spaces, is typically directly correlated to their future success. And I think that this is a type of financing that we're really interested in scaling across other markets, particularly as you think about the amount of capital required for storage build out or for EV charging or for other types of assets where there may be newer developers kind of like entering the market or kind of reinventing themselves in a new technology, and seeing where we can kind of lean in and provide the development capital that, if put against like a broad enough pipeline, avoid some of the binary development risks that you might otherwise get for backing single projects. So we're always looking for opportunities where, okay, we typically don't want to take this binary risk, but is there a way to collateralize and diversify? Is there a way to better understand the market so that we can get comfortable that what we're lending against is actually like, to some degree, a fungible liquid asset, and kind of work through that. So that's one I was super excited about. And I think, there's plenty of projects out there, but really getting into the weeds and understanding like which teams are the best to partner with, I think tends to be one of the most critical elements for success as an investor in this space.
Mandira, any specific climate-related investments that you want to talk about?
So one that comes to mind always is Tesla. This is a company that we invested in many years ago when it was private. And at the time, there were one of the maybe 2 or 3 companies trying to develop EVs, and we developed conviction in that team. And of course, there were many periods of time we didn't know if they were going to meet payroll or not. But that is a great example of a company that has been, it's not just about how many cars they sell, it's about what they've done to the industry. Their impact goes beyond the company itself, effectively forcing all auto manufacturers to look at EVs as a serious category. That's one that's always top of mind for me. In terms of future impact, I think there's several, again, because we are an allocator of capital. We are very fortunate that we get to partner with many venture funds, private equity funds. I just mentioned geothermal energy. That appears to be one sector that is, despite the lack of support for the climate sector as a whole, it seems to be one subsegment that will have a level of support from the administration, because the technology is very similar to fracking, but the type of energy that gets produced is very different. There's a fusion energy company that we have in a portfolio, again, purely because of the sector in which it operates. Energy generation is 25% of total emissions. So even if it makes a small dent in that sector, it will be hugely successful in terms of the impact it could have. I could go on and on. These are just a couple that come to mind.
No, thank you. Yeah, exciting to. Yeah, Tesla's one that's had a long story, and there were a lot of climate investors very early on there. We've talked a little bit about the market and some of the downsides there, but there's still plenty of investments to be made. And so I'd love to just hear sort of briefly, what sectors are you looking at right now? What are you excited about? And then a question from the audience of what niche investment areas are you particularly excited about? Any rabbit holes that you've gone into lately?
What investments are we excited about? The type of investments Marisa just described, investments where there is a good downside protection that produce predictable cash flows. In this current interest rate environment, it's a good opportunity to lock into some of those interest rates. So those are attractive to us from cash flow perspective. Private credit tends to be in that category somewhat, again, because of the low teen type returns possible over there now. It's, again, a good opportunity to lock into some of these cash flows over the long term. Niche investments. We funded a litigation financing firm not so long ago. What they do is there is a lot of environmental damage that's done by big oil companies and many other companies out there. And the plaintiffs in these cases often don't have the capital to go against these large corporations. We invested in a fund manager that front ends the capital need for these types of litigation situations, and we make the return whenever these cases conclude. It remains to be done how we'll do financially from this investment, but we're already seeing a lot of good stories coming out of there, a lot of feel-good stories coming out of there.
It's funny. I think I partially became an investor because I love nothing more than a good rabbit hole, and that's kind of like 30% of the job if you're like having fun with it. Yeah, it's interesting. We are looking at a business right now that's heavily involved in the environmental credit market, specifically at the state level. So these are typically state RPS-enabled programs, and they're incredibly profitable, but it's fascinating because like each of these state level markets is somewhat different and has its own nuances and niches and specific traders who trade it. And we've been spending honestly a lot of time doing like a market by market bottoms up analysis of a pretty esoteric financial product. So that's like one thing I'm into. But then maybe more less niche-y and more just kind of globally a theme that we're working on. I've encouraged my team to really think about like, let's do a reset of our base assumptions to a degree, because where we are in 2025 is really different from where we were in 2020 and even like 2015 when I was working in solar. And I think, for instance, the framework that we use to think about buyers of power and energy, what are their priorities? How do they think about resilience and trade-offs around availability versus cost, et cetera? I think some of those parameters have really like changed given where we are facing relative to load growth and demands on power. And we're kind of doing a bit of like a whole high level analysis around what are our own assumptions that may no longer be true, and let's make sure we like really understand where the customers in the market are today, and make sure that we're flowing that through our own investment analysis and screening, because I think kind of like the PPA model for renewable power has now probably migrated to whatever power you can assure will be 24/7 available to power a lot of our servers, et cetera, and what does that imply for opportunities in the space, and how does that both create constraints but also opportunities?
Yeah, maybe to build on that, we're really excited about investing in more areas of the grid. There's just incredible load growth right now. We were in many points in this country in a period of declining or stabilizing growth. We are in rapid load growth. And in many parts of the transmission system, you only get to 20% capacity of the line. So, using software and AI and sensors to better optimize what we currently have and get more and avoid curtailment, which comes at great cost. So this is a huge area of possibility. And it's also an area where I think the administration will continue to be supportive, because we need a stable grid, or we're going to be facing blackouts. In terms of niche, I think everything in venture is niche, sort of to Marisa's point. But we did an investment in a company out of Canada that is a rare earth recycler. So they are taking existing devices and recycling those rare earths. So also very timely topic.
Nice. Well, we got this other question from the audience that I think is sort of fun. What areas of climate, sector, tech that you do not believe in investing in, or why? And I think, each fund has their own different types of investment. So maybe things that you thought you would want to invest in and you ultimately decided, no, that's not right for my capital right now.
I'm going to take the question in like a slightly different way, because I'm just like, I'm not like a never say never kind of person. Even despite my risk averse investment position, I still like want to keep the dream and hope alive. But this is actually like a comment just around circularity, and at a high level, businesses that require taking waste material and then upcycling them. I have probably, and I am not exaggerating, looked at over 150 plus waste investments in like great detail over the course of my career. And I like love this space because I'm kind of like a circularity nerd and love the idea of like, being better with our resources and all of the stakeholders lining up to do this really beautifully efficient and elegant thing. And I continue to just caution and believe that space is really, really, really hard, particularly depending on like the types of waste material you're trying to handle, and particularly depending on the maturity of the markets that aggregate the feedstock required to create the upcycled material. So that is an area that I simultaneously love and spend a ton of time in, but have definitely become more, I don't want to say like closed off, but like extremely discerning as it relates to looking at those investments and understanding how and why those businesses can or can't make sense. And you kind of start to see the same movie like over and over again. But it's an area that I like remain extremely like hopeful on. So
for me, it's any company whose primary revenue or only revenue is coming from carbon offsets, voluntary carbon offsets. I think it's a very overhyped market. And most companies can't get to the right price point with the right amount of carbon reduction. So yeah.
There's one sector that we've been looking at for a long time, and we would very much like to get more active in it, which is ag, because there is so much both social and climate impact that can be derived from the sector. It's been hard to do investments there because the returns somehow don't match up, but increasingly we are seeing potential there, so I'm hopeful that we can get more active there, and it's a sector that clearly is in need of capital. We have done one-off investments in it, investing directly in companies, but we haven't supported a fund that it does exclusively that, but one that we hope to be more active in. And at your point, last year, it's been a few years now, we invested in this company called Redwood Materials, which is a circularity company. So going back to the point on recycling, again, that is one where investing in a whole theme might seem a little bit challenging. There's a company, Redwood Material, which was formed by a co-founder at Tesla, J.B. Straubel. They aggregate batteries, old car batteries, laptop batteries, and then extract all the materials from it. And the end goal there is, one, of course, you prevent virgin mining, and second is there's domestic supply chain. You don't have to rely on other countries. So that's one that seems to be doing well. We also very recently, just last week, announced an investment in a firm called Closed Loop Ventures. So that's one that is, again, it's not a company, it's a fund, so it's a little different from but it's a sector that's very important, at the same time not very easy to do. So.
Yeah, thanks all. We've heard a lot recently about the acronym FOAK, first of a kind, which is not that, that's sort of a recent acronym that's been thrown around lately. How do you all see the gaps in FOAK capital project funding being filled? You don't all have to answer it. I don't know. Marisa, you want to start off with this?
Yeah. Does everyone know FOAK? Like, who's looked at this in some degree of detail, like read 2 or more articles? Okay, that's like a third of the room. Good. So I have a lot of thoughts on this topic. That's why I was so excited to answer this. So first off, the Special Opportunities Fund typically is not doing first-of-a-kind investments because, like I said, mid-teens cost of capital, not exactly first-of-a-kind risk-reward payoff there. But that being said, I never want to say never, so like perhaps there could be a situation where we could potentially get involved. But I'm super intrigued by this whole kind of intellectual academic problem around how do you deal with pricing first-of-a-kind risk, particularly as you think about the typical funding sources that are around the table for the types of companies that are trying to finance first of a kind. And further to that, if you look at the types of technologies that have been able to cross that scale gap and how those relate or maybe do not relate to the other types of companies that are trying to do this and how challenging that is. So what I think is like just fascinating is you kind of think about the solar project with a PPA. Let's bring it back to like 1975, like the first time people were trying to do that, as the kind of perfect example of the type of technology that could scale up beyond its first of a kind. But the kind of like weirder you get moving away from that, I think the more challenging it becomes as an investor to distinguish around financing that plant-specific risk versus making a topco equity investment in that corporate that is building that technology. And oftentimes I get asked, hey, like, you invest in projects, will you look at this first of a kind project? And I often want to put it back to them and be like, you raised corporate equity. Can you walk me through why investing in the project is going to be different than investing in your equity from a risk return perspective? And I think if you think about companies that are doing a great job of like thinking through their folk financing, thinking through their milestone plans, thinking through their technology readiness criterias, they are really pushing themselves in that frame of how do we de-risk and how do we create a project that will ultimately demonstrate operationally what we will need to demonstrate in order to be a successful enterprise, whether that's under a licensing model or a different model. And 2, how do we take risk out where we can? Because in an almost perverse way, a lot of the novel aspects of technology, process, and opportunity that make things really compelling venture investments make them very scary infrastructure, $50 million capital type investments. And the folks that I've seen do this well, forgive the pun, are ones that look to partner with strategic partners that have like experience scaling businesses and building big things, are able to demonstrate from a commercial perspective a level of demand and revenue availability ahead of building the plant. And then 3, have around them not just the technology prowess, but the operational execution to build something big and like put all of those pieces together in a way that's de-risked. So there's my folk diatribe.
Thank you. Yeah, that was great. You should do that more. Mandira, I want to ask you a question from the audience here about fundraising. So that's a big challenge for a lot of different funds. And as an asset allocator, you have a different perspective on this. Are you seeing LPs pull out of certain asset classes? Do you think that's temporary? How do you think that might change over the coming years?
We haven't seen anyone pull out of any asset classes. There was a problem a couple years ago around the balance of capital, where public markets had pulled down and now private markets were a bigger portion of investors' assets than they had wanted. Now that issue has gone away a little bit. I think the macro environment is still evolving. There was news that even came out yesterday on there might be some signs of slowing down in Q1. So that, of course, is when events like that happen, folks take a pause. But we haven't seen anyone pull out of any asset class. People are being more cautious. Fundraising has been not as easy as before. For the more established investors, it becomes a little easier. But if there is a first-time, second-time, third-time managers, for these emerging managers, it's becoming increasingly hard, because when things get tough, you like to get behind folks that have done it 20 times and not 3 times, which is not a perfect state of affairs, because what we've seen is that it is these newer managers that have more energy and the hunger to do things more creatively. Those are the types of managers we are trying to back, at least providing the more catalytic capital. We know that the larger managers will be fine with or without us, but how do we get behind these more emerging stage managers and help them show us as an example of institutional capital that can then help them go out and attract other capital.
Yeah, that's so important.
There's no massive pullback out of any sector.
No, that's great to hear. I'm sure you all are very happy to hear that. Mira, I want to just ask one more question before we switch on to talking about careers, but could you talk a little bit about venture timelines to exit? There have been some concerns of just the timeline that it takes to invest in companies, and does that match with the scale of innovation that is needed for the climate crisis?
Yeah, so most funds are 10-year funds. Ours is a 10-year fund. So that means we're expecting exits sort of within a 5+ time frame. 5-year plus time frame. There are funds like Breakthrough Energy Ventures that are 20-year funds, and that's why you see them invest in much harder tech, longer timelines to commercialization. So it is worth understanding, both if you're a startup and if you're looking for a venture job, what is the timeline of that fund? Because that really dictates their investment thesis, how they operate, what kinds of companies they invest in. Also, for a lot of founders, it's very important to understand that expectation. Venture money, I often have to tell people when they're raising, this is what venture expects of you. And it's not for everybody. You know, we're not a commercial bank. So if you're, like, our cost of capital is 20%. So, and we allocate reserves into winners, to companies that are performing. That's the whole model, right? And it's just very important to understand that, because sometimes founders come to their venture investors like we're banks and expect loans when they underperform. And there are, you know, investors do bridge companies. They try to get them through hard times, but at the end of the day, you need to understand that timeline. So, yeah, I think not all companies exit with revenue. So to your point of, well, sometimes it takes longer. There are acquisitions that happen when companies are pre-revenue, and those can be good acquisitions. So it's not necessarily that, but that kind of gives you a view of the time scale.
Excellent, thank you. So I know most of you all are thinking about jobs, so we wanted to spend the last 10 minutes really thinking through, you know, what a career path looks like, how you all could start working in climate investing, or one day maybe even get capital from one of these investors. Maybe we could briefly start with just sharing briefly, like, your own path. Did you think you would be sitting here one day on an all-female climate investor panel? Marisa, you want to start off with that one?
Sure. The short answer is no. I didn't know that the career that I've built and the job that I have existed when I was in college. I just didn't know it was a thing. And I certainly didn't think it was something that I could do coming out of a state school in New York where I had to like fight my way into like a Wall Street job coming out of college. So to like say that like coming to this level is something I didn't imagine is 100% true. But I can tell you what I did imagine was working in a career that fundamentally challenged me and made best use of my skills, which tend to be external facing people stuff and then rigorous analysis. And then the second piece is actually working on something that matters like broadly in the world. And within like my first year of working at Goldman, it was clear to me that if I was going to build a career in finance, it needed to be around things that actually mattered and had some form of substance beyond the financial markets, because otherwise I would simply burn out after maybe like 10 years and maybe go like move to Bali or something and become a yoga teacher. So I'm glad I stayed in it. But I will say it can be sometimes hard to find like your entry point or even like feel out like what your space is that you want to like go into. For instance, like I think climate VC gets a ton of attention, understandably, because the VC model is like kind of around, you know, supporting your companies, showcasing your theses, and really like doing a lot of press. But in reality, from a capital allocation perspective, that's actually like a pretty small amount of the capital that's being put to work in climate. So one of my like drums that I always beat when asked this question is, please consider infrastructure finance. And there's so many companies, both on the investment side and then also just on the operational developer side, where you can get fantastic jobs that are great training grounds for A, rigorous financial analysis, which will never be bad no matter what investor you are, and two, are right in the heart of climate. So think about like renewable energy companies, even if it's not as sexy maybe as like some deep tech VC role, I think like it can actually have a huge amount of career benefit, and just keeping in mind that the career you're building is likely, hopefully, like decades long, and that look in kind of maybe like unsexy but still highly relevant places.
Yeah, when I was starting out, there was no such thing as climate VC, so I don't know if I would have imagined being on this panel. But I started off, my first degree was in science, and I started off in the conservation sector. And I always cared about climate change. I was always worried about it. And so I started working with mining companies, and I was a partner to mining companies. I was living at a very big platinum mine in South Africa. And when I was working with the mining companies, it was very efficient, good relationship. I developed a lot of respect for the people in mine management at these different mines that I was working with. And so I said, I'm going to go inside the belly of the beast and work on change from the inside. And that's why I went to Haas, and then I transitioned into industry. So I spent over a decade in, like I said before, chemicals, utility, and oil and gas. And I specifically picked very hard sectors because that's where you can make a really big change. And so I then moved to venture with that experience and in bringing that to the early stage. So I think the message here for you is that in this field, there's really no straight path, and it is going to evolve. So what the careers are today are probably going to be very different 3 years from now. And also we see a lot of specialization. So, you know, before where, you know, there was like, when I was in Haas, I was part of Net Impact, and it was, everyone wanted sustainability jobs. And what did those look like? You were a sustainability person. Well, now it's actually being an infrastructure investor or working in, you know, some part of the food supply chain. And so I think my message here is that climate is actually embedded in so many things in a very granular way. And so you kind of need to open your mind about what does a career with impact really look like.
First of all, I think kudos to all of you. You're here for a very specific topic, ClimateCAP. So you have a vision for your careers, which is more than at least I had for my own. I sort of did it by accident almost. In fact, when I was entering the field, there was nothing like impact investing. In fact, even if we did impact investing, we stayed away from that term because it had almost a concessionary tone to it. Now we feel more comfortable calling ourselves impact investors. Back in the day when we went to raise capital, we were, oh yeah, maybe we should refer to your grant folks because they are the people that give grant. We're like, no, we're not here for grant capital. We're here to make money. So for me, I grew up in India, finished my education 1.0 in India, worked there for a few years, and this was back in 2006. I'm dating myself here. There was not very many career opportunities for someone like me. So I decided to explore this part of the world and went to school in UIUC. Again, accidentally landed at Intel in a very traditional corporate finance role. Had my eyes on their venture capital and treasury teams, which were very difficult teams to break into because they were very selective. So I spent, while I was doing my corporate finance job, spent a few years getting my CFA, and then something opened up there, joined venture, and realized 3 years in that it didn't excite me all that much. Not venture, but the software and hardware investments did not excite me very much. So I decided to move over to Capricorn, which for me resonated with my personal values a little more, and met with the team, really fell in love with their vision, and I'm here now, like 12 years later, still with the firm. My only message would be just be very flexible. You never know. I think there's very few people out there that start with the perfect careers or land in the perfect job that they want, but you never know. Doors open up, and they open up in the most unexpected ways.
I want to dive in a little bit deeper. Any specific skills that people should be trying to get in these next 2 years, 3 years, however long your MBA program is? Anything you would look for in someone you would want to hire in the near future?
It's a broad tent, right? It really depends on where your individual expertise is. If you are already a finance professional, of course, investment banking, private equity would be a good slot in. If you're an engineer, helping out on more sort of technical due diligence in venture investments or even infrastructure, or project finance person would fit well into infrastructure. If you're none of the above, fear not. There's still many opportunities out there, and once you get into any role, it's about how do you then leverage that role to get into the next thing that you like better.
I would say 2 for us on our team that are super, super important. One is comfort with ambiguity, because when you're in this kind of like downside protected, but also kind of spicy priced capital, you gotta like really dig into things and ultimately kind of take a view. And if you're really like a black and white thinker, I think it can be really hard. And you have to start to get comfortable with your conviction, but also have an ability to both like defend and accept like criticism. So that's a big one, and I think it doesn't necessarily like get said enough. And I think the second one is also just intellectual curiosity, like being excited by the idea. So not only are you like comfortable with ambiguity, but like you actually think like, oh wow, what an exciting thing that I get to dig into to try to figure this out, as opposed for like that being like a source of stress and anxiety.
Yeah, those were my 2 as well. Yeah, it's really important to understand that and kind of reflect on yourself. You know, is it the right role for you? But I would say the one that I would add is just the soft skills and building relationships, because when you're in venture, you have to go through some very hard times with founders, and it's really important to kind of build that trust with them and the board. And it's through your networks that you find great companies to invest in. So being able to build relationships over time.
I want to just ask one more question for the climate founders out there. I mean, we've been addressing this for the most part to people who are looking to get into the climate finance world, but for those who might one day want to get capital from one of your funds, any specific recommendations, maybe things that you think would position someone better when having conversations with financiers? Like how should they be framing and talking about their ideas with you?
Well, I think number one is kind of coming back to my point, really understanding what you're signing up for when you talk to a venture investor and what their expectations are. And make sure that you're in for that. And then your pitch needs to align with what they're looking for, and don't just make it up, because every investor will find out if you're making it up. But you need to have a massively scalable business, and to be honest, that's not every business. We look at a lot of companies that are great businesses, but they're just not good for venture. So that's the main point of advice I would give.
For us, I think it's an awareness of what it takes in order to scale. it doesn't mean you have to have every piece in place, but the founders that impress me the most, honestly, are the ones that are like doing their homework and looking 3 to 4 years ahead to figure out like, when we do have to build the $300 million facility, that's a 30x scale up from what we have now. Who is going to finance that, and who do I need to know in order to get that financing? Like, the people who impress me are the ones who can kind of manage both what's in front of them plus what would be needed for the future, because it's what that would be needed for the future is what has to happen to realize the value. And I can like think like off the top of my head, like it's something that I can usually suss out pretty early, like in a pitch, kind of how well aware is a given founder about what are all the pieces that need to come together. And it doesn't mean that they themselves need to drive every piece, but like the comfort and also almost sometimes like humility to like realize that they don't have it all figured out, but they can like they're the leader to bring in the right expertise is huge.
Anything else you would want to add?
I think that covers it. I think just to have a huge level of conviction in yourself and your idea, because on the other side of the table are a group of people whose job it is to poke holes in your thesis, and you need to be comfortable enough to then defend it in a way that is easy to understand, not to overcomplicate things, and just have a long-term vision and be open to feedback. We sometimes see founders who get very offended when they're given a no. It's an opportunity for reflection instead of getting offended, and do better in the next pitch.
Well, thank you all for coming. That was it for today. I hope you all enjoyed the panel. Let's give everyone a round of applause. Excellent. Thank you all. Thank you all for being here and coming to Berkeley.